Well, hello everybody and welcome to today's webinar on looking after the finances, the basics of banking, tax, bookkeeping and financial management. And I'm delighted that we've got Estelle Rowe with us today, who is one of our Unlimited mentors who is delivering this session. So we are, as usual, recording the webinar, and if you do have any questions throughout, if you'd like to post them in the questions box, we can do a bit of a Q&A at the end with any questions that you might have. But without any further ado, I'm going to hand over the controls to Estelle, and in a few moments you will hear Estelle and see her screen.
Hi everybody, I hope you can hear me. My name's Estelle Rowe, and I just want to say thanks to Julie really for inviting me to give this webinar on this gorgeous Friday afternoon. So I hope you're all ready for this. Shouldn't take up too much of your time, but hopefully there's something in this presentation today that you might be able to take away with you. So just a little bit about me first of all. I specialise in looking after the financial health of social enterprises, charities, private sector organisations, and I offer what's known as a flexible finance director service. That means that people can buy my time if they need to on a one-off basis or as they need it. And I also work with organisations to deliver business planning, change management, tendering for new work and bidding for funding. So I just wanted to start out by just saying for just a second that a lot of people say to me, well, I don't do finance. That's quite a common comment that I get. And I'm just hoping today that actually we can just run through some of the basics here so that people can feel a bit more confident, can know where to ask questions and perhaps get some information and perhaps just feel a little bit more comfortable with some of the basics, because it's not rocket science, a lot of this stuff, and you don't really need to feel too afraid of it if you just get yourself organised and work out what it is that you're meant to be doing. So just a word of reassurance to begin with. Okay, what I'm hoping to cover then is firstly around just a few key points about banking, bookkeeping and bits and pieces around tax. I won't go into too much detail. The problem with things like this is that every case is different, so giving specific advice is really hard, but I'll try and cover the basics. And then I'd like to talk about financial management, which I think is really, really important in any social enterprise or any business for that matter. And I'll go through stuff around financial planning, financial control and financial reporting, and then maybe there's a bit of time at the end for some questions. Okay, so just thinking about banking then, first off. The first issue really, I think, when you're starting up your social enterprise or any business for that matter, getting the banking right from the start is actually really important. Sometimes it's just one of those jobs that people think, oh, I've just got to do, and you get on with it. But actually, it's really important to get the right bank, because banks can be really helpful, and they can also be an absolute pain in the neck. So you want to get it right from the first, really. So one of the things I say is, please have a think about what you want from your bank. You may want different things. Organisations are different, and different banks offer different types of services. So, for example, if you're a social enterprise and you've got ethical values, you might want to think about using, for example, a co-op bank because it's a co-op. You might want to go for some of the business support services that some of the other more commercial banks offer. For example, Barclays or some of the others, Yorkshire Bank, for example. The next thing you need to consider is having the right type of bank account, because, again, there's a variety of business banking accounts, and you do need to get it right. Think about the kinds of things that are going to hit you down the line. It's not just about now. So have a think about what the charges are going to be like, what's the charging structure, and after that free period of banking that most people offer, are you actually going to get hit for loads of charges? and what is the kind of business that you're going to be doing, because if you're going to be doing lots of online transactions and they're free, you know, obviously that's worth considering. So there's different components of the charging structure. Also investigate things like overdrafts and how receptive your bank is to giving out finance, because again that's another thing that you're going to need to consider at some point. Some banks are better at lending than others, and obviously, you know, lending to small businesses is at an all-time low, but some banks are actually better than others at lending. So for example, come across recently Yorkshire Bank, which seems to be much more flexible in terms of its overdraft policies and things like that. The other thing to say is that you don't actually have to have a separate bank account, you know, to keep your business affairs separate from your company affairs, but I would recommend it highly, because it starts to get awfully complicated, and it may be more convenient for you when you start up, but actually in the longer term it will probably be more hassle than it's worth, and you could get into all kinds of bother. So try and separate your private affairs from your company affairs. And the other thing to think about on banking is around the kind of relationship that you might have with your bank. Because as I just alluded to before, you know, you might want to seek finance at some point. It may be something on your list, high up on your list. And having a good relationship with your local bank is really important. What I found is that a lot of banks send out their representatives and often senior managers into networking groups and to conferences and seminars and things like that, and you will get to meet these people, and you know, some of them are great, they're absolutely fantastic, and if you can set up a really good relationship with someone from a bank, then actually it could be worth its weight in gold to your business at the end of the day. Okay, just moving on from banking then, just wanted to talk briefly about understanding what your company and your personal tax liabilities are going to be, because you need to get on top of those from the start really. I don't know if there are any sole traders out there. Most of you are probably working within company structures, but if there are any sole traders, you need to make sure that you've registered with HMRC, and you need to make sure that you're on top of self-assessment. If you don't notify HMRC, you'll become liable for all the tax that you've not paid, and there'll be penalties on top, and you can get really stung. And I've seen examples of that before, where people have not realised that they had to register, come to the end of their first financial year, and then realise that this is something they need to do. So please remember that if you're a sole trader. If you're in a company, any kind of company, you're going to be liable really for corporation tax. So that you could be in a CIC or in a private limited company, company limited by guarantee. There'll be corporation tax to pay, and that's something that I'll come on to in a minute. You'll also have the submission of all the PAYE stuff and national insurance deductions from any payroll that you've had to set up because you're employing staff. And again, that's something that you really have to keep on top of. If you've got a payroll provider, make sure that that payroll provider is able to satisfy HMRC's requirements for real-time information. It's really important that it's an online updating system where monthly returns is sent off to HMRC. Your payroll provider must be able to do that. If you're doing it yourself through Windows, they'll have the date when your ES will arrive. So just make sure that the council know who you are. And then the other element of tax liability, which I'll come on to in a minute in a little bit more detail. And also, if we could just say, in addition to sole traders who must go through the self-assessment process, company directors in their own personal right will be liable for tax, and probably ought to be filling in self-assessment returns if you're not already doing so. So please remember that, it's important. Okay, so just having a little look at corporation tax then. Corporation tax is payable, becomes payable 9 months and 1 day after the end of your financial year. That's not the accounting, sorry, the HMRC's financial year. That's your accounting financial year. The small company rate, that's on anything up to £300,000, I think it is. It's 20% on any profit that you make after all those allowable deductions for tax. So obviously, it's it's a decent whack, and it's something that you've got to keep on top of again in terms of your accountancy requirements. In terms of what you're allowed to deduct from your profit calculation for corporation tax purposes, there are a number of allowable expenses, and it's worth getting to know what those are, because not everything can be charged into the accounts to become deductible for corporation tax purposes. So there are 1 or 2 things that get taken out of the calculation. So it's useful to know what those are, and there's guidance on the HMRC website. It's always worth actually looking at HMRC because they regularly update their web pages. If you get advice from other sources, you're never quite sure as to whether it's been updated. So when it comes to things like tax affairs and stuff like that, anything to do with HMRC, I'd always recommend that you go and look at their web pages direct, because you're getting it from the horse's mouth then. The other thing, which is a slightly different issue, but it's a taxation issue nevertheless, if you're a one-man band, just make sure that you're aware of the IR35 regulations. I'm not going to go into too much detail, and I'm happy to sort of take 1 or 2 questions on it if you want, but IR35 is a regulation that's designed to trap people who are sort of operations consultants, but they're more or less working in employed roles. And sometimes people get a bit hot under the collar about this, and sometimes the HMRC does as well. So you need to know, if you're sort of in a consultancy type job or company and you're on your own, then you need to be careful of IR35. Just moving on then to VAT. VAT is something that you need to consider if your turnover is going to, in the current financial year, exceed £79,000. That's the current threshold, and that changes every year. So again, just keep on top of that, because it does go up every year. It's actually compulsory to register if your sales are going to start going over that threshold within the accounting period. So you need to keep a close eye on your turnover if your company is starting to get up to that level and you've not already registered. You can register a year, that's not a problem, but it does take a little while, not very long, but you just need to be aware of that. Make sure you don't upset the HMRC by going over the threshold and not having registered. You can actually deregister, so if your turnover falls, you can actually deregister at a later stage. Obviously there's a bit of hassle in that, but there are pros and cons of being VAT registered, and obviously you need to think about whether or not it's appropriate and keep that under review really. So there's a number of different schemes that you can be on with VAT, and I'm not going to go into lots of detail because it becomes very complicated. But basically, there are a number of sort of schemes that could make your life easier. So the standard accounting scheme for VAT is basically where you keep tabs on your expenditures and you keep tabs on your income and all the VAT elements within that. And then basically you sort of, you do your return to the HMRC every month probably. And if there's any difference between the inputs and the outputs, you pay the difference. You can actually go onto what's called the annual accounting scheme, which actually means that you've got a sort of a longer period of time to be able to assess your VAT, and you make payments on account, and then there's a year-end adjustment. So it actually becomes a little less onerous, really. It's not necessarily suitable for smaller businesses. Usually they go onto the cash and the flat rate schemes. The cash scheme is quite useful actually for smaller businesses, social enterprises, because actually you don't start to pay VAT back to HMRC until you've actually got the cash into your books. And that obviously helps because you don't want to be paying money out if you can absolutely help it until you've actually got that money in your bank account. So the cash scheme is basically worked out, as it says, on the cash that comes into the business. And then there's another scheme that you can be on as well as the cash scheme, and that's the flat rate scheme. And instead of working out every single transaction and working out the VAT difference between inputs and outputs, you can actually pay a flat rate of your turnover. So typically those rates range between, I think it's 11%, and they go up to quite a high level. It just depends on what your business is, and there's a long list of all the different businesses and which percentage rate is applicable to them within the flat rate scheme. It's something that it's worth having a look at and working out which is the best scheme to be on, because it can make a difference, and they do actually cut down a lot of the hassle and the bureaucracy. So if you're going to go into something like that, have a chat with a bookkeeper and accountant and see if they can help you work out which is the best VAT scheme to be on. Okay, moving on then to bookkeeping. There's a few golden rules really when it comes to bookkeeping. I'll come on to different types of ways of doing bookkeeping in a minute, and software packages, things like that. But whatever you do, whatever system you use, it's really important to keep really good records when it comes to bookkeeping. You've got to make sure that you record everything. It's no good just sort of recording a few things and then forgetting, and then having to catch up. You've got to pay regular attention really to your bookkeeping. Just a little anecdote, maybe something that perhaps made me go into finance. When I was little, my dad was a plumber, and he used to keep all his receipts and all his invoices in his carrier bag, and he used to dump them on the accountant's desk in this bag about 2 months after the year end, and it was just awful. It cost him a lot of money to have it sorted out, and never kept them in any kind of order. And it cost him actually in the end, in terms of penalties and things like that because of lateness and what have you. So you've got to pay regular attention to your bookkeeping. Also, I suppose it stands to reason really, but just make sure that you are accurate in your bookkeeping, because a little mistake in a spreadsheet somewhere, or an error here or an error there, can actually be quite a serious issue sometimes, and you don't really want to get it wrong. So try and get it right. Check over your figures every now and then. And just do some little accuracy checks if you can, especially if you're using a spreadsheet. The other thing about bookkeeping is that it's good to keep on top of it, because you can actually start working out where it is that you can maybe put a little bit of cash aside, or where you've got a little bit of surplus that you might want to sort of set aside for what I call the rainy day. So that's rainy day management. If you keep on top of your bookkeeping, you've got a better chance of being able to do that really. And then the final golden rule of bookkeeping is that you've got to keep to your deadlines. Now that's not just the year-end accountancy deadlines, which I'll come on to towards the end of the presentation, but it's also your deadlines for all your returns to HMRC, your PAYE, your national insurance, and any tax returns, VAT, and whatever that you're having to make. Make sure that you know when those deadlines are, and make sure that you've allowed for that in your work programme. So there are different bookkeeping methods. If you're going to do bookkeeping yourself, most people in small businesses keep a record, probably on a spreadsheet, on what's known as the cash basis. So that means you've probably got, I don't know, 12 columns, maybe one for each month, and you record your transactions in the period when the cash comes in. So you may have invoiced, I don't know, for something in April. If the cash comes in May, you record it in your spreadsheet in May, and the same goes for any expenditure. And that's a very simple in and out sort of way of looking at things. There is another way of doing it. It's known as the accruals basis. The accruals basis records transactions in the period in which they actually occur. So if you, going back to the original example, if you invoiced in April, you would record your income in April. And that has the benefit of matching when your expenditure is incurred and when your income is incurred in the same period. So it actually gives you better information. Cash basis is better maybe for small businesses that are doing it on their own. Accruals is probably going to give you better information overall. The thing is, you've got to make sure that you're consistent. You've got to, if you're doing it yourself, you've got to make sure that you're doing it on the right basis. Don't swap between cash and accruals basis because you get really mixed up. If you've got an accountant doing it for you, you don't have to worry about this. They will probably keep all your records on an accruals basis, and they'll prepare your year-end accounts on an accruals basis as well. But if you're doing it yourself, you need to have a think about that and make sure you know what you're doing there. It's always good to have a chat with a bookkeeper and see, what they've got to advise you on. Make sure that you're getting it right, because otherwise it'll just take you ages and ages to sort it out afterwards. So here's my favourite David Tennant photo with his sonic screwdriver. I think the moral of the story is here, you've got to have the proper tool for the job. As I said before, it's not actually compulsory to have some kind of whizzy software package. You can keep your bookkeeping records on a spreadsheet, that's entirely legitimate. But for any kind of business which has got any level of transactions going through it, you may want to have a think about a proprietary software package. Be careful though, because they do vary. Some of the desktop packages, like for example Sage or QuickBooks, they're great packages, but you've got to know what you're doing with them really. So if you've got someone in your company who's got a bit of bookkeeping experience, that's fine. If you've got a bookkeeper perhaps who comes in and works for you, I don't know, a day or 2 a month or something, on a desktop package, that's fine. But if you purchase one of these systems and you don't know what you're doing with it, you could be letting yourself in for a bit of trouble. So what I would say, it's probably worth having a look at some of the online systems. And there are a number of them actually. One of the ones that I'm extremely fond of is called Xero. That's spelled X-E-R-O. I think it's actually originated in New Zealand, but it's a fabulous little online accounting package. Very, very simple to use. You don't really need any bookkeeping experience. It's all explained in very down-to-earth layman's terms, quite intuitive, and it's also inexpensive. I can't remember the exact fee, but it's not a lot. It's something like £15 a month, which is, it could be less than that actually, which is really good actually for an online system. And there are a number of other online accounting packages which are equally as good. One of them is called Cashflow, that's cash with a K. There's another one called Free Agent, that's a good one. And then there are other accounting packages such as Sage Online and Home Accounts and various other ones, BrightBooks. Sage Accounts, although it's cornered the market in the desktop world, my opinion on that is really that in the cloud, online, it's not all that great. So you might want to have a look at Xero or something before you start going down the Sage Online route. Okay, if I can just come on to financial management now. That's something that you need to get into a discipline of really when you're running a company. Good financial management for me boils down to 3 things. That's around good financial planning, having good financial control, and also making sure that you know what you're doing when it comes to the financial reporting requirements. So starting out with financial planning then, one of the things that really it's good to get into the discipline of doing is setting a budget. And I've said here for the most appropriate time period, because it's not necessarily the case that you would set a budget on an annual basis. Some people, they may have various uncertainties, there may be changes about to occur in the business, and it's appropriate to only set a budget for, I don't know, a month or 6 months or something like that, and that's fine. It's a good discipline to pull together all the things that you think you might have to spend on, all the anticipated income that you think you're going to get in, and start pulling together a plan for, you know, whether or not you're going to break even in the year, and have a think about what you might need to do if it's not looking good. I think the thing about budgeting is that a lot of the time people are very optimistic when it comes to setting their figures. If you think back to the fact that many people do a business plan when they first start out in business, business plans are great for funders, they're great for getting your thoughts into gear and helping you to think through the issues. But business plans are very rarely based on anything like reality. And so if you started out with your budget by using what you put in your business plan, please just try to be realistic and try to have a think about what's been happening, say, in the first few months of your business or the experience that you've already got, it's a year or two, and think about what's going to be realistic, but think forwards as well. It's not just about thinking backwards, it's about thinking forwards. It's about looking at what's going on around you, what could have implications for you, what's happening with your competition, and generally trying to read the market. And also include everything, because you know it's quite easy actually just to leave something out, and you know, you don't want to be caught out by having forgotten a large item. And of course, going back to your tax liabilities, all of those kinds of things need to be factored in. The next thing I'd advise is to take your budget and break it down into a cash flow, because having a budget is not the same as having a cash flow scenario. I'll come on to the difference in a minute, but it's really important that you understand what's going on with your cash. What are the inflows of cash? What are the outflows of cash? And when are they going to happen? I'll come back onto cash in a minute. But just to say that before you move on, and before you say, right, I've done my budget, done my cash flow, just have a little think about modelling, which is a bit of a technical term for looking at what happens if. Start to do a little bit of playing around with your figures if you can. Start to model different scenarios, maybe different income forecasts, different assumptions around your expenditure. Think about what might happen if a key supplier goes bust and you have to start using another supplier. Would that mean more expenditure or less? Those kinds of issues can be quite important to have a think about. Just make sure that you've thought about some of the key risks that you might face over the coming year. And if you think some of those things are a distinct possibility, you might want to go back to your budget and your cash flow and adjust your figures, because it's worth being a little bit pessimistic when it comes to some of this stuff and then having a nice surprise afterwards. Okay, so just a word then to say, you know, if you can avoid the fag packet scenario where you're actually literally you're forming your budgets, forming your cash flows on the back of a fag packet, please at least use the back of a receipt, because it will give you a little bit more space to write a few more figures down. But if you can, in all seriousness, you know, sit down with a pen and paper or a spreadsheet and have a good old play with the figures. Don't leave yourself exposed. Coming on to financial control, it's about monitoring. It's about monitoring those cash flow forecasts that we talked about before. But it's also about monitoring your profit, and I'll come on to that in a minute. It's also about having proper financial internal controls, and it's also about thinking about your profitability. We'll come back to the power of 1% in a few minutes. So there is a difference between profit and cash flow when it comes to controlling your finances. It's useful to know the difference. Profit is really just an accounting term. It's something that accountants look at when they look at your income and they look at your expenditure, and that's on an accruals basis. So the income that you're owed for, say, the year, even if it comes in after the end of the year, and the expenditure that you've paid out within the year, even if you end up paying for it after the end of the financial year. And it's the difference between the two. Cash flow, however, is the real life difference between what's coming in and what's going out. And there's a difference between cash and accruals. So it's worth bearing in mind that actually cash is the thing that could actually kill you if you start to have a difference between what's coming in and what's going out. So if you're paying out more than you're getting in because, for example, your people who you're invoicing are taking longer to pay than you actually pay for goods and services in, then you could be in a position of having a negative, what's known as a negative cash flow, and that's why profitable businesses can still go bust. So a friend of mine runs a carpet business. It can take him a long time to get his money out of customers, but he tends to find that he has to pay his carpet suppliers within a month. So obviously in that situation, he's got a difference between the money his company's got coming in and the money he's got going out. And when he's got less coming in, he has to get an overdraft to finance the difference. That's why a lot of businesses are going bust, because the banks aren't lending, and there's this difference between inflow and outflow of cash. So I'm not saying that profit isn't important, it is, and I'll come on to that, but cash is extremely important, and knowing where you are with your cash is the most important thing probably that you need to know in your business. So cash flow tips then. Have a system for actually getting paid. You've got to have some form of credit control system really. Have terms of payment. Make sure that you know what you're going to do if someone isn't paying. You have a set of procedures that you go through, and you stick to them. It's about having some discipline really. It's all very well to have nice relationships with the people who you're supplying, but actually if they're not going to pay you, it could threaten the life of your business. So going back to the financial planning points, forecast, forecast, forecast. Always make sure that you know what to expect when it comes to cash. If you're on top of your forecast, then you've got a better chance of managing your cash flow properly. Make sure that you trim expenditure whenever you can. Try to always have a look at payment terms, for example, or discounts that you might be able to wrestle out of your suppliers. It's always worth asking for a discount. Times are hard, and if you can trim your expenditure, then it's going to help with your cash flow. So negotiating good terms as well as a part of that. I've said avoiding the shiny things. Those are the expensive new little laptops and iPads and all those nice little gadgets and lovely things that you might want to have for your office, and all those nice sort of boxes of stationery that you really need, but actually you may not really need to spend on. So try to avoid the temptation of the shiny things. Check, check, check. That's always about going back to your forecasts and just checking what actually happened. Make sure that if you've got a cash flow figure, say for the last month, you go back to that forecast and you actually look at what really happened. Make sure that you reconcile to your bank account, you know where you're up to with your cash, and you know, for example, if you've got a nasty surprise coming a couple of months down the line because some money didn't come in last month or something like that. And revise, revise, revise. It's always about going back to your cash flow forecasts and revising them in the light of what's actually happened, so that you've got a better forecast for the coming months. Okay, I'm just going to go on to a little bit of figure work now. Apologies for this, but I just wanted to show you a little calculation around profitability. It's called the power of 1%. Cash is really, really important, but unless you make a profit in your social enterprise, you're not really going to be able to fulfill your social purpose, what you really want to do. You've got to try and make a profit. So what I've done here is just pull together an example of the importance of improving your profitability and always knowing where you're up to. So I've just done a very basic breakdown here. In the left-hand column, you'll see a column of figures showing, first of all, the costs of a business. So this business here has costs of £8,050. That's fixed costs. That's things that it has to pay out come what may. could be the lease on some premises or something like that. And it has some variable costs of £1,400. Those are things, supplies that it pays for according to how much it actually supplies. Its total cost £9,450. It's got a selling price of £220 per unit, and it's selling 50 units, so that means it makes £11,000 in revenue. You work out the difference then between the revenue and the total cost. That's the difference between 11,000 and 9,450. It brings profit of 1,550. That's a profit of 16% on the total cost of that business. Now the power of 1% comes in when you actually say to yourself, well, if I was going to trim my costs by 1%, I was going to try and just nudge my selling price up by 1%, and I was just going to try and put that extra little bit of effort into the number of units that I sell by just 1%, then I'm going to be able to, first of all, reduce my costs to £9,355, increase my selling price to £222, that's only a small increase, just sell one extra unit and make that little bit of extra revenue, then my profit's going to be £1,967. That's a 21% profit. Now that's quite a significant difference on the 16% profit. So you can see that just having that little bit of financial discipline there, just having that 1% in your mind, can I trim my cost by 1%? Can I just nudge my price up by 1%? Can I sell 1% more? It's going to give you that extra little bit of profitability. And that could make all the difference. That could make the difference between your business staying in business and actually going bust. So financial management is really important. If you can just think about it in basic terms, I'm sure it'll help. The moral of the story really is that actually you shouldn't let things get out of control. It's easy with finance to just put it to one side, or just, oh, I'll do that tomorrow, maybe do that next week, and things get a little bit out of control. And it's harder to put right once they get a little bit out of control, and it takes forever. So try and keep on top of it, and don't let things run away with you. The other thing about control, and just going back to that first slide, is about having some internal controls. Because when your business grows and you've got people working for you, it's very easy for things to become a little bit haphazard and a little bit ad hoc. So keep tabs on your business by having a system of controls. Make sure that you've written down somewhere, and you and your employees all know who are the signatories to the accounts, who's allowed to sign for what are the limits of people's, say, ordering powers, what are the rules for hiring staff in the business, what are the limits of delegation or of responsibilities that you might give to people, so that they know where they stand, people know where they stand in the business, and then when things go wrong, you've got some fallback because you've actually written it down somewhere that these are the things, these are controls that we've got in our organisation, these are the things that we're going to stick by. I can't tell you the number of times I've seen a nice, friendly kind of business sort of go awry, really, because actually the internal controls weren't good enough, and people sort of just did what they thought, really. And in the end, one or two people, you know, they may take advantage, they may not necessarily do it deliberately, but you know, they may overstep the mark a little bit, and it can cost you dearly in your business. So just make sure you've got some controls in place, and everybody knows what they're doing in the business, what they're allowed to do and what they're not allowed to do. And then finally, just going on to financial reporting. It's sort of like the final bit in the jigsaw, and it's one of those things that ends up costing you a bit at the year end, because nearly all of the time people will be using an accountant to actually pull their financial reports together. But it is a necessary evil, and actually your final accounts, your financial accounts, can tell you a lot about your company. So if you don't know how to read a set of financial accounts, I'd encourage you to try and find out, because it can be very illuminating. And it's also very handy to be able to read your competition's accounts and other people's accounts. Say, for example, people who may be new customers, who you're not certain of who they are and what their track record is. Being able to read a set of accounts is a really good skill to have. So try not to dismiss your financial reports as just an unnecessary overhead. But I think a good pointer to use here is that you really should try and get a trusted accountant. Try and form a good relationship with your accountant. Some people do it themselves. I'm an accountant, but even I don't do my financial accounts. I like to have somebody doing them for me. It's a fresh pair of eyes. It's someone who can look at my accounts independently. And then I can just check them at the end and make sure that they look in order. So get yourself a trusted accountant, someone who you can rely on. Second point here is about being prepared, because very often when you're in the thick of the business, there's so much to do. Your year end can come and go and you can not even notice it, and then you've got 9 months to prepare your accounts and send them into Companies House, and make sure you've done all your returns and all the rest of it. And if you're not prepared for sending that information to your accountant or getting your internal bookkeeper to do it, then you can end up scurrying around at the last minute and really giving yourself a load of unnecessary stress and hassle. And equally, know what you've got to do. For example, if you're a community interest company, it's not quite as straightforward as just filing a set of online accounts, say for a limited company. You've got extra requirements for the regulator, and also, when I last looked, you can't file online. Someone I know recently was badly caught out with that, left everything to the last minute, and then found that there was a whacking great penalty because they couldn't file online and they were late. It's probably worth saying, I don't want to frighten anyone, but it's probably worth saying that it is a criminal offence to not file your accounts. So you've really got to make sure that you're on top of it here and know what you need to do and actually take responsibility, because it's all very well saying, well, I've got my accountant and they know what they have to do. But at the end of the day, it's your responsibility. If you're the director of the company, or company secretary, you've got to be filing those accounts. You're the person who's going to be liable, not the accountant. So, you know, on your head be it really. Take responsibility for what you need to do, and then you'll be all right. Just plan it ahead, make sure you know what you're doing, and then you should be okay. Just one word in the end. This is my lovely photo of my lovely white elephant that I encountered at Glastonbury a few years ago. Everyone's saying, well, that's just a white elephant, but actually, to me, it's a really fantastic little sculpture it's actually made of recycled milk cartons. And all I would say is, just going back to my earlier point, with your final accounts, it's not a white elephant. It's not an expensive thing that's going to sit on the shelf. It's something that you can use, and it's something that actually knowing something about and understanding is really well worth the effort. Okay, so that's the end of what I've got to say. I've tried to pack quite a lot in. I realise there might be some further questions. Let me know if it's helped, and also let me know what else you need to know, and I'll do my best to answer. Thanks a lot.
Thanks, Estelle. That was a really, really informative webinar, and certainly a lot of information to take in there. We'll just talk for a few minutes to give people the opportunity to type in any questions that they might have, and also to say that we will be able to send the slides out after this webinar and the recording. I understand the sound, we lost the sound very briefly in the middle, but I hope people didn't miss anything, and if so, if people do have questions or anything that they feel that they missed when the sound went for those couple of minutes, then please drop me an email and I can follow up with Estelle to make sure you get the information that you need. It's not appearing that there are any questions. Oh, here we are. There's a question, so that's good. And please type in any more. So, if your turnover is very low for the first year, is it still worth paying for the services of an accountant? So I'll leave that with you, Estelle.
Well, yeah, it may be. I understand. I mean, it's a big overhead, isn't it? If you're going to have to pay an accountant to prepare a set of accounts for you, and your turnover is minuscule. I mean, there are other options. Accountancy firms typically do charge more than bookkeepers, and there's some very good bookkeepers who are perfectly capable of producing, a good set of accounts and something that's compliant with, with all the Companies House requirements. And there are other options as well. I mean, there are, in some areas of the country, community accounting services, which, will supply sort of very low-cost services. So you're not just restricted to going to an expensive accountant, and it's certainly not compulsory that you do that, but you have got to make sure that you're confident enough to submit a set of accounts that's the best it can possibly be to Companies House. And the other thing to say is that if you file your accounts with Companies House and then you subsequently realise that they're wrong, and you take them, you sort of amend them, and then you submit them, and it happens to be after the deadline, then you will get a penalty. So you just need to consider really, what's the best way of spending your money. It's a value for money decision, and getting to know a good bookkeeper could save you a bit of money there. So I don't know if I've answered the question, but I think you do have some options. You can do it yourself, but you've got to know what you're doing.
Yeah, no, I think that was helpful, and actually leads on to the next question, which is how do you actually find a good bookkeeper / accountant?
Well, there are a number of ways of doing that. I mean, one of the ways that you can do it is by using some of the very useful forums that there are. Unlimited itself runs various forums on LinkedIn and what have you, and the Community Interest Company, I think it's called the CIC Association, isn't it, has forums. There are a number of sources for actually discussing, your business issues with colleagues, and I can't see anything wrong in seeking recommendations through forums like that. I mean, obviously, it's all very well to get a recommendation, but you always need to check it up yourself and make sure that you've spoken to the person who's been recommended to you, and you've got to feel comfortable. There are various things that you can look out for in terms of qualifications on websites and that sort of thing. You're looking for people to be qualified if they're an accountancy firm. It's called CCAB, and there are a number of accounting qualifications within CCAB that are, recognised and legitimate. So that's one of the things. You can also look for membership of professional bodies on those websites as well. That will also go for bookkeepers, although they may not necessarily be qualified accountants. That's okay too. Part qualified accountants are, still skilled people, but you need to make sure that they've got a track record of doing the kind of work that you're asking them to do. Ways of coming across these people, other than, say, online recommendations, are through word of mouth, in your own networks, going to network meetings where you may strike up ongoing relationships with people who are in the business. People recommend people, don't they? People buy people. So very often, it's about how comfortable you feel with a person. And it's always worth doing a little bit of shopping around, a little bit of homework before you actually make your decision, as to who you're actually going to buy. You may also want to get in touch with your Chamber of Commerce and any other sort of support services that you may have in your area that may have lists of companies. They probably won't be necessarily recommending them, but there'll be lists for you to start having a look through. So there's a number of different ways of doing it. My accountant was somebody who we'd known through our family for a while, and somebody who I trusted. That's how I did it. And I just checked out his website, made sure he was a member of the ICAW, which is the Chartered Accountants Association, and did it like that.
Thank you. And I think if people are recommended to you. You can check them out on LinkedIn as well, and people often get recommendations on LinkedIn. So I think that's a good place to look for accountants. There's also an organisation which I don't know if people are aware of called ProHelp, which was established by a business in the community, and essentially it's a network of firms who are committed to making a difference in their community by offering services for free to community organisations. So you might want to go online and have a look at ProHelp, because you might be able to get some pro bono accountancy to start with in the early days, before you commit to having a bookkeeper or an accountant longer term as your business develops. We have another question here, which is, when you file your tax return, if you're doing it yourself, what's the best way to find out everything that you can claim for? For example, electricity when you're working from home.
Okay, this is quite a complex area, and it's not something that I can really sort of go into in too much detail on a webinar like this. There is information. Unfortunately, I feel on this that HMRC has, although it's got the information, it's actually a bit tricky to plough your way through. But having said that, it's coming from the horse's mouth. And I would always caution against kind of just taking as gospel some of the stuff that you might read on other forums and things like that. There are some things that you can claim for. So generally speaking, it's known as use of home as office. And there are some rules as to, or some thresholds rather, as to what the HMRC will kind of just not even bother looking at, and where they might become a little bit interested. So I forget the figure. I think it may be something like £13 or £15 a week in terms of a charge, you know, for using your home as an office. Anything under that, HMRC just wouldn't be bothered with. But you've got to go into it in some detail. I think you've got to be confident that what you're charging into your accounts is legitimate. So again, I would always seek the advice of an accountant if you can, or a good bookkeeper. Somebody who's been familiar with doing this kind of stuff for a while. The other thing to say about accountants is that, of course, because they have such a lot of dealings with the HMRC and their local tax office, they'll know some of the inspectors, they'll know how they feel about these things, and they'll kind of get a feel for, what you can do and what you can't do really, and what's pushing the boundaries. Because often, HMRC will take a view on these things. It's not always cast in stone. But that said, there are some defined things that that you're allowed to do and you're not, and you've got to go into HMRC really to look at that, to understand it, and back that up with some advice, I think, from an accountant. If you want the link, I can probably dig it out for you. But if you were to go into HMRC and type in something like use of home as office, you'd probably get some search results there that would take you to the relevant pages.
Corporation tax. Did you catch that question, Estelle? Can you hear me?
I'm sorry, I didn't hear a thing, no.
Oh, I don't know what happened with the sound then. Is there a threshold at which you can start to pay corporation tax?
No, corporation tax, well, only in the sense that corporation tax is calculated on your profits. So, if you don't make a profit, you're not going to be paying any tax. But no, corporation tax is just worked out on the calculation that your accountant or your bookkeeper will do on the amount that's left.
business through Twitter. So I think that'll be very useful for everybody. Okay, well I think we'll draw to an end now. And like I said, I'm not sure if everybody can hear, but hope you all have a great weekend. Thank you again to Estelle, and we'll see you on the next webinar. Okay, bye.